All right, we're still in Objective 1. We're working with current liabilities, and now we're going to work with a different type of current liability, one that has to be estimated. So its counterpart as a current asset might be bad debt expense, for example. So where you had to estimate how much bad debt expense you're going to have under the allowance method. So um, the one we're going to talk about is estimated warranty payable. We're going to talk about first. So when a company sells a product, they know they're going to have some returns, and they have a history and experience with that. So when they make the sale, it generates. So we're trying to match the expense with the revenue generated. When they make the sale, they know they're going to get the return, some amount of returns. They're going to estimate it, recognize the expense at that time. When the return happens, they won't have the expense. They'll just remove the liability. Okay, so Valverde Incorporated sells bicycles. They got a 1 year warranty, and they, from their experience, know that for every 100,000 in sales, they expect 2,000 in warranties. So it's a 2% rate. Um, Warranty claims are almost always handled by replacing or repairing the product, so we don't have any cash payments associated with it. In year 2001, they sold $10 million. Record the warranty expense. So the entry is warranty expense, and then the liability, current liability, is estimated warranty payable. And we're going to use a percent of sales method. So we have 10 million times 2% is 200,000. And that's where the debit or credit comes from. All right. Now, what happens when they're actually settled? During 2001, they had 120,000 claims. So they increased the liability 200,000, but they settled 120,000 in claims. So we didn't do the journal entry here, but it would have been estimated warranty payable is the debit, so reducing the liability, and the credit would have been out of inventory. All right, as they're replacing or repairing the bike. So the ending, the warranty payable balance at the beginning was 180. So the question asked, what's the ending balance? Well, you ended with 180. You made 120,000. You took care of 120,000 in claims. You added 200 through your percent of sales method. So 180 less 120 is 60, plus the 200 is where the 260 comes from. All right, so you get a net increase of 80,000 and warranty payable to liability during the year. And that's how you take care of warranty payable. There's another type of estimated current liability. This one we're not going to do the journal entry for. Um, but you should know conceptually how it works, and the three definitions I'm going to talk about in just a second. So these are contingent liabilities. So the possibility of making a payment is contingent upon future events occurring. So think of a lawsuit, some other legal action, dispute with a government authority such as EPA or IRS. So you're arguing about your taxes, or the EPA may have you clean something up, but you're still disputing the amount. So those are contingent liabilities. A lawsuit, it may be that you could end up owing nothing, right? The amount could vary greatly. So how do you deal with this? This is GAAP. Here is GAAP. And there's three possibilities. You're either going to accrue it, so you're going to recognize a liability. You're not going to accrue it, but you're required to disclose it, which is in the footnotes of the financial statements. And let me be clear, the footnotes are legally part of the financial statement. So the financial statement is not complete without the footnote. You're learning about income statement, balance sheet, statement of retained earnings, cash flow statement. Those are the primary statements, but the footnotes are legally part of the statement. If it isn't disclosed or accrued, and if it's remote, you don't have to do anything as a corporation. Okay, you don't have to put it in your financial statements at all. All right, so you're going to accrue it if the loss is probable. And let me just say, in accounting, this is it has a term that's known in the profession. It doesn't necessarily mean 51% or greater than 50%. It means that there's a significant chance it could happen. So some people might think 30% or even 20% is probable. And the second thing is, to accrue it, it has to be can be reasonably estimated or reasonably estimable. Um, what this means is, since we have to rely on these financial statements, and it has to be faithfully represented, that if you can't come up with a reasonable estimate, you're not going to recognize liability. All right, so if you have estimates that vary from 0 to 10 billion, and you're not quite sure how to put any of the probability on one part or the other, then, but you know there's some loss probable, but you can't estimate it, then you won't accrue it, you'll just disclose it. Okay, if it's reasonably possible, and once again, this is all caps because it is a specific accounting term, but not remote, so it's reasonably possible, which means it's not remote, then you'll disclose it. So reasonably possible is something less than probable and something greater than remote. That's the best I can help you with right now. And remote means it's also a part of GAAP. It has a specific meaning to professionals. Remote would mean no one really thinks it's going to happen. Could something weird and unforeseen happen with a lawsuit or whatnot, or Congress change the law for your EPA case or whatever the issue may be? Yes, but you don't, for the current facts, you can't see any reason why you would have to end up incurring any loss in the future. All right, so estimated liabilities, you have your warranty. We came up with a specific number. For contingent liabilities, you should know when to accrue, when to disclose, and when not to disclose. In addition, know the terms probable, reasonably estimated, reasonably possible, remote, and remote. All right.